Hey, in this video, I'm going to talk about buy a call option. So when you buy a call option, you basically buy a right to buy a stock, right? So when you buy one call option contract, you are buying a right to buy 100 shares of specific stock at a price before an expiration date. I'm going to tell you what all this means. So here, when you buy a call, it's similar to say it is a long a call. When you buy, you are long. When you sell, you short. So buy and long interchangeable. Sell and short also writing is interchangeable as well. So just a little concept there. So okay, you buy a call option. So usually when you buy a call option at a brokerage firm, so that usually at the end, after you place the option, that will usually give you this, say, long XYZ January 60 call at 3. So let's see, look at it, what does this mean? So long here said the investor has bought the call and has the right to exercise the contract. So you bought, right? You bought the option. Then XYZ, so yes, a contract includes 100 shares of XYZ stock. So basically, it's like if you buy Apple call option contract, that will be 100 shares of Apple stocks. So January, the contract expires on the third Friday of the January at 11:59 p.m. Eastern Time. So basically, they tell you this is expiration date. So usually this when it's weekly, they may not display the year, the date, right? So when you buy a expiration date much longer, they will have the full date to displayed. So then 60 is the strike price of the contract is at 60. I'm going to show you what does this mean. So then call is a call option, right? So this type of option is a call, and the investor has the right to buy the stock at 60 since he is long the call. 3 is the premium of the contract is $3 per share. The contracts are issued with 100 shares, so the total premium is $300. The investor paid the premium to buy the call. So basically, that's your cost for to buy this one contract. How much does it cost you? $300. So that means this is buyers of call want the market price of underlying stock to rise. The investor who owns this call hopes the market price will rise above 60, and then have the right to buy the stock at the strike price 60, even if the market is higher, for example, at 80. So a call buyer is a bullish investor because he wants the market to rise, and the call is exercised only if the market price rises. Okay, I'm going to show you an example. So this is Tesla. Tesla market price on October 26, 2021. Basically, it's today I'm making the video. So what do you think about Tesla future performance? Right now, it's $1,000, $1,014.35. So the PE ratio is 354. I remember a year ago it's about 1,000 PE ratio. So basically, you look at the Tesla. What do you think? What's the future of the Tesla performance? a year from now, 2 years from now. So if you think, 2 years from now, Tesla price will increase dramatically, you may want to buy a call option because, you have the rights to buy the stock. So let's just see an example. Here, this is on today. Today, basically October 26, 2021 option price. This is a call option price. Here I'm showing you the Tesla price right here. So here, basically a list of the call price. This is a strike price, right? Let's see. You have to see if the lower the strike price. What's the strike price? Basically, you have the right to buy the 100 share of Tesla at this price. If let's say you buy this call option $900, you can see this $900. You buy the rights. Say I want to buy Tesla stocks $900 per share. What is this Tesla current price? It's $1,014. So you buy below the market. So this one, they tell you this is in the money. So basically, when you buy, you already can exercise it. You buy this one, buy at $900 per share. If you exercise the option, then you turn around, sell at market $1,014. So you will make a profit. However, you will pay much higher premium. So basically, the premium is much higher. You can see last price of this call option is $288 per share. You can see that's significantly high, right? So if you buy this call option, is out money. The strike basically is a strike price is higher than the stock price. You can see the premium is lower, right? So in the call option, the lower the strike price, the higher the premium. So the higher the call price, strike price, the lower the premium. That makes sense because, those risk. This one, you already have some money, in the money. Basically, you're not losing all the money, right? So, okay, anyway, so we look at this one. So this is expiration date is in March 17, 2023. Basically 507 days from to expiration date, right? So if you buy this call option, say the strike price is $1,150. I'm going to show you here. You can see they display like this. This is from my brokerage account, so I'm showing you here. So you can see they give you this quote: Tesla expiration date is March 17, 2023. Then your strike price is $1,150. Then this is a call option. You can buy a call option. You can sell a call option. So you can see here. If you when I do a buy, they give me this. They give me a quote, right? When I buy a open one contract Tesla, so with an expiration date here, the strike price, a call option, they give me a quote. The quote price is $19,550. So this is for 100 share, right? So for the premium is $195 per share. This is then then you would read at the end, if I place the order, they would give me this. The long, I'm buying the Tesla call option. So this call option, the expiration date is March 17, 2023. So 1,000, the strike price $1,150. Then the premium I'm gonna pay is $195.50 per share. Then this contract is 100 shares. Current Tesla price is this today, right? So if I am buying, place the order, so this is gonna be my call option I just bought. And so let's look at this. So why I would want to buy this call option? So basically say, well, this is a long time away. March 17, 2023 is, currently is only 2021. That is almost 2 years away, right? So in March 2023, if I buy this call option, what I'm thinking is, say, if the Tesla stock price goes up, so I am more hoping the Tesla price, I would think Tesla price would go up to $3,000 per share in 2023, even sooner, right? I was thinking about this, but do I want to buy, 100 share of Tesla, with all the money? You can see $1,014 per share. If I buy, 100 shares, that will give me, I have to put $100,000 in it. So then if I just buy this call option, you can see the premium I have to pay is $195 per share. So that give me this quote. So if I buy this call option, so I will pay $19,550. So $19,550 for almost 2 years. Then this is the right for me to buy the 100 shares of Tesla. If Tesla stock price go up, like go to $3,000 per share, $4,000 per share, you can see I'm gonna making money on this. So that's why you want to buy a call option, right? So let's look at it. Currently, if I place the call option today, we have some terms. This is out money. Out money is like the strike price. Strike price is $1,150. Then this is greater than the market price. So basically, when the strike price is greater than the market price, this is called out money. So out money. So basically, you if you exercise, you don't have any profit. Then break even. Let's think about it. So break even, I am place money in this option. So per share, I'm paying currently. I'm paying the option per share is $195.50. Then if I want to make money, then the stock price has to go up. So because I have the rights to buy the stock at $1,150, right? So you add this together, that's your break even, because you already have a sunk cost $195.50. The stock price, you only make money when the stock price go up. So when the stock price go up to $1,150, you are actually break even. No, if the stock price go to 1,345.50, you are break even. So because you can buy at this strike price plus your premium, so then you can break even at this one. So the stock price you have to look is have to be higher than $1,345.50. Higher than this, then you can make a profit. So if lower than this, you're gonna lose money. Something called intrinsic value. Intrinsic value basically is the strike price, is the market price minus the strike price. So currently you can see your market price is below the strike price. So you don't have intrinsic value. Intrinsic value only when your price is in the money, is you have an intrinsic value. Basically, your strike price is lower than the stock price. That's in the money. You have an intrinsic value. Intrinsic value always greater than 0. So let's do it again. When your strike price, this strike price is lower than the stock price, so you have an intrinsic value. Basically, you have some profit in it. So let's assume on October 26, 2022, next year. Let's see next year. If the market price of the Tesla gonna go up to $3,000 per share, so what are you gonna do? That is a great news to you, right? So you're gonna make money. What are you gonna do? First, you're gonna exercise. You're gonna buy 100 shares. 100 shares of Tesla at what price? At your strike price, because you get the rights to buy at a strike price, right? So that's the option. Then what do you do next? You turn around, you sell the 100 shares of this Tesla stock at $3,000 per share. So then you'll have again $1,654.50. So you can see the gain you can see is not your $3,000 over your strike price. You have to know what's your cost. You paid the premium here, so you should use the sale price minus your break even. So that's your cost. What you put in, right? So that's your cost. So $3,000 minus your cost. So that's your gain. Then total profit is you times, this is per share, 100 shares, you're going to make $165,450. So you can see why you want to buy a call option. So that's because if you committed less money, so then you can make a profit. Of course, a lot of times you don't have to exercise to really buy the share. In the option market, you can turn around just sell the option, make a profit from that. You can do that as well. So you don't have to buy the share and sell the share. So you don't have to do that. So that's just say, basically show you how to make money on the option. So why do you buy a call option, right? I just show you most people time because you believe the stock price gonna rise in the future. So you are very bullish about the market. So you you think Tesla gonna do very, very well in the future, so then you think the stock price is gonna go to $3,000 per share. So that's here they try to say call buyers are bullish on the underlying stock. So by purchasing the calls, and investors can profit from an increased stock price while investing in relatively small amount of money. So you can see that, right? So basically, we just did with the Tesla stock, we speculate, right? The speculation. With speculation is the most common reasons for buying calls. Investor can speculate on the upward price movement of the stock by paying only the premium. Buying the actual stock would require far greater investment. So you can look at the Tesla example. You can see the market price is $1,000 and $1,014. This. So if you say, you know what, I'm just gonna buy Tesla, I think in the future gonna rise. You buy 100 shares of Tesla, you have to put $100 and $1,000. You have to put over $100,000 in the market in order to speculate, right? To invest in Tesla. Then there for you, if you just buy the option you only pay the premium is $195 per share. So which is you only do 19,000, which is only cost you $19,000. So when you know, if the market goes up, so you definitely have a much higher return on the smaller money. So call option give you much greater return. You can see previous example, if your return is $165,000 in less than a year. So on your principal was only 19,000. So you can see that is great return to you. So that's just said is speculation. However, the downside is if the stock price is not rising to that much, so you're gonna lose it because you don't own the stock, right? You don't own the stock, then you by the expiration date, if the stock price never reached to the point that you make a profit, then you gonna let the option expire. So then you will lose your $19,000 here. So you will lose the entire premium. So you can see that. So because you don't own the stocks, that's the speculation. The other one is protection of the short stock positions. Say if you today, you think the Tesla stock will go down, so that's why you short the stock, right? You sold 100 shares of the stock at this $1,000 today. Let's say that's your commitment. You get proceed $100,000 today, then you were hoping the Tesla stock price gonna go down to $800 per share, so then you can buy the stock back. That's when you short it, then you buy back, you make a profit of $200 per share. So you make a $200 per share. So you make a $10,000 on the stock. So anyway, the point is if you sold a short stock, you sold a short, basically you short Tesla stock 100 shares, but you worry about the market if go opposite, they go up, right? if the market goes up, because there's no upside gonna go up, then you need to you at some point you need to buy the stock back to return the shares. So that's why you want to protection of the short positions. Investor can use the call protect the short stock position. The option act an insurance policy against the stock rising price. So you basically you buy a call option to protect your short position in case the stock price goes up rather than go down. Okay, so that's just something. So that's another reason. Deferred decisions. So this is basically say an investor can buy a call on a stock and lock in the purchase price until the option expires. This allows him to postpone making the financial commitment other than the premium until the expiration date of the option. Yeah, basically say if you think Tesla stock gonna go up, so then you don't want to really commit to over $100,000 to in this investment. You can just buy a call option, then just kind of postpone your decision. So diversifying the holdings. With limited funds, an investor can buy a calls on the variety of the stocks and the possible profit from the rising the option of the premium, right? So basically say, well, if you only have $100,000 to invest, you are like if you speculate on a Tesla, this option can allow you to speculate on not only on Tesla. You can buy 100 shares of Apple option, 100 shares of Amazon option. So if you are not using option, you just buy the stocks. You can see your 100 share will all go to Tesla. You cannot invest in other stocks, right? So that's why they try to say you can commit a small amount of money to speculate on different stocks. Then maximum gain. Theoretically, the potential gains available to call owners are unlimited because there's no limit on the rising in the stock price. So you can see it's the higher the price the stock price goes, then the more profit you're gonna make. So that's maximize gain. Maximize. They should say maximize the gain, minimize the loss. So so basically the maximum loss. So for call option, all the thing you can lose is your premium, right? However, if you put an entire $100,000 buy the Tesla 100 shares of the stocks, so you can see all the $100,000 if it go to zero, you have much bigger loss than the option lose. Option this buy a call option, maximum loss is your premium. It's your $19,000 premium. You can see that. So that's about buying a call option.